All right, what's going on, YouTube? My name is Jelfi Torres, and today I wanted to go over what I believe is one of the most fundamental things about market structure, which is impulse and correction. I believe once you have a better understanding of what an impulse and what a correction is, then you'll be able to take smarter trading decisions, whether it's taking a trade, managing your trade. Okay, that way you're not stuck in the moment where you're like, okay, price is doing this, but I'm already in the sell, so I'm kind of stuck. I don't want to lose any more money. You understand? So I don't want you guys to feel that once you have your sell bias, you can't convert that into a buy bias while you're managing your trade. Meaning that doesn't mean that you like close your sell and then start buying. What I'm trying to say is you close your sell because you have indications that the price action wants to head higher. Okay, so here we are in GBP USD on the 1 hour time frame, right? And we went back to about September of 2019, and we're just going to be labeling impulse and correction. So for the impulse, I will label it with an I, and for correction, I will label it with a C. Okay, and let's go. All right, so we are starting from this bottom here. So this here is an impulse. All right, what is an impulse? An impulse is an instance of strong demand or supply in the market, meaning that price is moving strongly with a lot of momentum, big candles in one direction. Okay, it's fine whether it does this little small movement here, that doesn't matter. The overall direction is to the upside. Okay, this is just little increments of information given to you. And then after that impulse, what usually follows every impulse is a correction. Okay, price had a small correction. Corrections could also be interpreted as consolidation, but it really depends. Here it's consolidating because it's staying within this area here, right? It corrected slightly downwards, but then continued its momentum upwards. Okay, so here we have a first impulse correction, and then after that, let me just leave this here. We have another impulse. So what's another condition of an impulse? I would say break of structure. So here we have that virtual resistance line that a lot of retail traders are drawing right here, right? And what I'm seeing mostly from this is that it's not really helping you determine where price action can go, because it's not really looking at the overall market structure, which we already had this impulse proving demand has entered the market. So here we have another instance of demand entering, breaking structure. Structure overall is this over here, right? And what's followed by the impulse? Another correction right here. So this correction is a bit different. Not all correction and all impulses are the same, but as you can see, corrections tend to be slower and smaller, movement done in smaller increments. Like you see these candles are much more smaller than the ones that you see in the impulse here. So we have a correction going downwards, right? And then after that, we're followed by a small little impulse. Just a small one, slight one that's enough to break out of this structure on top of that correction that occurred, right? It broke above that structure. And usually after an impulse breaks out of structure, it corrects to the previous structure. So here, it corrected back down. This move here, the intent of it was just to correct back to the previous structure where there was where price initiated its impulse. Okay, and then after that, we had another impulse, back up, breaking this structure here, right? And then what was followed by that? Wait, sorry. Should have put this correction here, just in case you missed it, this correction. And then this is another prolonged correction. Now, if you were to measure in time, let's see how long price took to get from here, this candle here, to the top. So I'll say this is the top, this took 7 hours. And then for it to come back to this zone where this red candle is, that took 3 days and 18 hours. So corrections take much more longer than impulses. I want you guys to take note of that when you're analyzing the market, okay? So another instance of correction here, and it corrects to the previous structure where price initiated its impulse. Right here, see? And where price initiates its impulse is usually a good area to keep an eye for the next impulse. Once price is trending, okay? Now we're in an uptrend, and this just proves that we're gonna continue that uptrend, okay? So this here, another instance of what? Of an impulse. We had an impulse upwards. We broke this structure that's to the left of it, right? And here we have a zone where price is essentially consolidating. And this consolidation lasted about 3 days and 2 hours, okay? So what was done here? Essentially building liquidity on top. And as you can see, though there was liquidity on the bottom, let's say here, here, and here, that was all cleared, all cleared. So wherever price action tends to not clear liquidity is a true market direction. That's a little cheat code for you, okay? So we had our impulse, now we're consolidating, we're not challenging the highs, we're challenging the lows, and eventually price comes back to where price initiated its impulse here, okay, to this breaker, continues the trend. So this here would be our correction. And after that correction, as you can see, it breaks this structure here to the left of it. And this is our new instance of an impulse right there, okay? Guess what's followed by the impulse? You guessed it, a correction. Here we have another correction. Slowly back down. And again, I want you guys to focus on this tool here, which is the amount of time it takes. So let's just say to reach the top, this took 14 hours. And for it to come back, that took about 3 days. Okay, corrections are very slow. They're very, very slow. Impulses are where you'd prefer to be. Okay, and like I said beforehand, the correction usually goes back to where the impulse originated. So in this instance, it's a bit different because what we're doing here is in this entire zone, let me just clear this up a bit. Okay, here, what we have in this zone, we have balanced pricing, meaning that for each Great Britain pound that's exchanged for $1, it's equal, 1 for 1. They're equally exchanged. And once we broke out of that, right here, this is what's called inefficient price action because there's an inefficient amount of Great British pounds because on the way up, that's GBP, and the way down is dollar. So here we have Great Britain pounds, right, that are not being equally distributed with dollars. There's a lack of dollars here. There's a lack of the red candles. Where is it? The lack of that. So what price does is that it comes back to where, where price was last balanced. So it's not always going to be precise, but I want you guys to just keep that in mind so that you're more knowledgeable in terms of what's going on in the market. Okay. All right. So let's just go until like down here, and then I'll wrap this video up, but let's continue on for now. Here we have another impulse break structure, the structure to the left of it, right? And then again, another correction. And as you can see, not all corrections are the same, right? Impulses are very easy to see because it's like taking the elevator up. But corrections are different. They're always different. All right, so here we have this one. It's not, challenging the highs as much as the lows. The lows are getting spiked in a lot. Comes back to the previous structure. The structure here. That's where price came back to. Another impulse. Outside of that. And then once you see this kind of price action where you see strong demand, right? And then that high is challenged, and then there's a break of structure to the downside. This is what I call induction of buyers. And if it were, the opposite, it would be the induction of sellers. So what happened here essentially was the market wanted to gather as much buy orders of retail traders as much as possible before reversing the market, hitting their stop loss, taking that cash away from the majority, okay? So we have this impulse down. Once we have that induction of buyers, right, we have a small correction right here. This correction. Another small impulse back down. This is very, very small one. Of just this right here. Small impulse. And I would even argue that this entirety right here, this is just consolidation. Price, it's evenly balanced, and price on its way back up. This is our correction. Okay. If you confuse this for an impulse, you're not looking at the price behavior or the candles of an impulse. Look how clean those candles are in the impulse. Look, see how clean that is? This is wick central right here. So this is a correction followed by another impulse. Okay. All right. Hope you guys found this helpful. Just please take time and just analyze the market. Look for impulse and corrections. Notice the price behavior between an impulse and a correction, and that will help you with deciding where to enter the market, when to close a trade, how to build a bias, whether we're in an uptrend, downtrend, whether price is more likely to go up or down. This is fundamental to understanding market structure and building your bias as to where is the market more likely to go. This is a game of probability here. All right. Okay. Thank you guys so much for watching. Take care now.